Starbucks has just reported its earnings. In fact, it was a double miss on both counts. We'll take a look. But interestingly, the share price is up 2%. So are we looking at a company that is at the bottom? Is it now an undervalued buy now company? We'll take a look at the historical performance. We'll look based on their latest earnings at their top line revenue growth as well as their bottom line net income. We'll have a look at the health of the company, their total cash versus total debt. Is this dividend sustainable? We'll see how they've performed versus some of their competitors over the last 5 years. We'll touch upon their dividend safety with the announcement that they did have in their earnings, and we'll look at the financial metrics. We'll also take a look at the institutional ownership. Are institutions buying in the more recent quarter? And we'll discuss a lot of insider selling by the CFO just a few weeks ago. And we'll take a deeper look into their earnings. And as always, we will run them through the valuation model. Based on their earnings report, get to the new intrinsic value. What is their acceptable buy price given our investor margin of safety? And what is Wall Street expecting for the next 12 months? So let's take a look now at their earnings. Now we can see the headline reads that Starbucks earnings disappoint, one, due to the boycott in the US, as well as that cautious Chinese market. Now we can see, as I mentioned, they did miss on both the earnings per share as well as the revenue. And we can see the CEO does state headwinds in the US due to the US boycott as well as that Chinese consumer. And their same store sales increased 5%, which unfortunately was significantly shorter than the 7.2% Wall Street had estimated. So let's take a look at their numbers. So earnings per share 90 cents was what they reported. The Wall Street were expecting 93, so they missed by 3 cents per share. Revenue 9.43 billion, expected 9.59. So not great. They did in actual fact miss on both counts. And when we take a deeper look, we can see their net sales rose 8% to 9.43 billion. Now, Wall Street were expecting 7.2% for the same store. Unfortunately, it only increased by 5%. So we can see this is probably a very poor earnings report for Starbucks. And interestingly, when we do take a look at the current trading price, it is up around 2%. So are we looking at the bottom that we had seen just a few days ago? The company, well, it is down still 12% over the last year. When we maximize that to the last 10 years, they are up 159%, and we can see their all-time high at around $126 in summer 21. We do see it is trading in the mid to lower end of the 52-week range with a forward yield of 2.42% and a forward PE just under 23. So in terms of their top line, now we do expect 3 to 7% at the bare minimum. September 2019, 26.5 billion on the top line. October 23, their latest annual report, 36 billion. So nice growth to their top line over the last 5 years. It has been increasing, but do note that COVID year did impact their top line, which we always explain it is justifiable. And then it rebounded nicely, and we can see nice consistent growth year on year. So that is positive in my opinion in terms of their top line. Don't forget, we will look at the top line increase over the last 10 years percentage format too. Bottom line, 3.6 billion in September 2019. October 23, 4.1 billion. So again, the bottom line also increased over the last 5 years, but we do note that drop in that COVID year, not just to the top line, but also to the bottom line. It did rebound nicely, but it did then fall in 22 before picking back up. So both top line and bottom line do look positive. They have increased over the last 5 years, but there are some small inconsistencies, which we can believe are justified. In terms of a quick health check, 2.8 billion cash in September 2019, 3.4 billion per their latest annual report. Now, when we compare that numerically and directionally to their total debt, we can see it has gone from around 11.2 billion, more than double, to 25 billion. So let's touch upon that when we look at the net debt to EBITDA metric as well as that dividend safety. A few companies in a similar sector, the consumer discretionary restaurants industry, Chipotle, we have DoorDash, Yum Brands, lots of well-known companies. Now, over the last year, this includes those dividends reinvested. Starbucks are down 10%. We can see one of the worst performing in the industry. When we maximize this to the last 5 years, we do see them actually one of the better companies, up 55%. Not bad, not great, mediocre, 55%, but we do note it is the second best, significantly behind the outperformer Chipotle Mexican Grill. Now, as we always say though, do bear in mind, especially for new viewers, that past performance is never an indicator for future performance. Institutional ownership, 70%, $7.3 billion worth of sales by these institutions over the last 12 months, more than 3 times buying by these same institutions over the same period. So institutions do like Starbucks. Clearly, it is something that they do like to buy. And we can see their biggest buy came in Q2, $15 billion. Although while we note Q3 had more selling than buying, in the most recent quarter, institutions bought significantly more shares of Starbucks. Remember, always do your own due diligence. Never copy what institutions do. Very quickly then, we have put Starbucks through the insider trading screener, and what we can see, a significant number of insider selling by the CFO as well as the chief partner officer and group president from the international space. So we can see that they have sold many shares. In fact, the largest one was in November at $681,000 worth. But as I always say, insider selling isn't necessarily a bearish signal. They sell for many reasons. And interestingly enough, we can see that during some of these share price sells, the price has risen. If we look at the more recent one, the share price has gone up, in fact, 4% from when Sarah Kelly, the chief partner officer, did sell just a week ago. So it's nice to have and use as part of our essential analysis. But again, I would much prefer to see a company do share buys, insider buying. It is a bullish signal. Insider selling, less so in terms of being a bearish signal. Dividend safety score, 67. It is safe. Market cap, $107 billion, a mega cap company. Now, those key recessionary metrics, they didn't pay a dividend in the last recession. Above average growth, but they did significantly trail the S&P recession return, 69% negative versus the S&P's negative 55. Dividend growth, a recent increase, 7.5%, above that 4% inflation we advocate continually on the channel. Double digits over the last 5 years, double digits over the last 10 years, very, very strong. We love to see that as dividend growth investors. And they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, well, we can see that sign of undervaluation. Remember, it states a company is undervalued when the current yield sits above the 5-year average, 2.38 versus 2.01. We see a very similar story of undervaluation, 22.6 on the forward PE, below the 5-year average of 29. Although we should note that Starbucks is much higher than the sector PE of consumer discretionary at 14.7. Free cash flow payout, remember we ignore earnings, it is susceptible to manipulation by management through accounting. Let's focus on free cash flow. 2023 at 67% is decent. 2024 expected slightly lower at 65%. Decent as well. Ideally for me, I like to see 60% or lower. I can live with the mid-60s, but around that 60% gives me faith that management do have that ability to offer those double-digit increases in the future. Free cash flow per share, well, it has gone from negative 37 cents to $3.20, and it is expected to increase slightly in 2024. So yes, it has increased, but we do see a lot of periods where it stays relatively flat or increases, but then following year it does decrease very strongly. So again, do bear that in mind. It isn't a fast-growing company. Their free cash flow doesn't increase sharply year on year. Always good just to understand the type of company you're looking to invest in, and then doing reasonable projections over the next few years. Pretty much every single year, double-digit increases to the top line. You know, we always stay steady, moderate growth, 3 to 7%. Nice to see for Starbucks, even in their latest year where they did miss on analyst expectations, they still increased their top line by 12%. And we can see they've more than doubled that top line from 16 billion to 36. Shares outstanding, well, they've also done share buybacks. Very nice to see, returning excess cash to investor pockets, as we can see. So that is always a very positive sign. And when we take a look at the ROIC, remember you do want 10% or more for this metric. I personally don't touch companies that don't have that metric at that number, because that gives me faith that management are able to effectively allocate their capital. Starbucks looking very solid, in fact above 12%, above 10% as well for every year bar that COVID year. And in fact from 2021 it has been increasing, which is a very good sign. Operating margin and free cash flow margin, it isn't perfect, it is straddled around the minimum that we look for, so maybe something just to keep an eye on, but nothing to really worry us right now in this moment of time. Net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, remember, shows us the balance sheet strength as well as dividend safety. These are the number of years it would take them to pay off all of their debt net of cash on hand. 2023 at 2.06, very positive in my opinion. It is expected to go below 2 in 2024. The dividend does look to be safe. The balance sheet does look to be strong. It is below that 3.5 maximum, so no real worries with Starbucks so far. In terms of the valuation, let's jump in. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, obviously, regular viewers know we will ignore Graham's valuation. They are increasing their revenue very fast, rapidly, above double digits every single year. So let's start off with the first model, the multiples valuation model. We have the companies in a similar sector and size, their PE multiples, average multiplied by that of Starbucks to get an intrinsic value of $122. So we have that first sign of undervaluation. Bear in mind though, we're not looking at any of these models in isolation, and we will draw conclusions towards the end. Dividend discount model, nice growth over the period. In fact, just under double digits on average. Forward looking, we have gone more conservative at 6%. This gives an intrinsic value of $121, not far off the previous model, and we can see that undervaluation signal. We then move on to the DCF model with the free cash flow year on year. Average growth rate pretty high. Forward looking, we've gone in line with analyst estimates, and that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We have an intrinsic value now with an overvaluation signal, just slightly under the current market value. So the intrinsic value in today's episode for Starbucks is just the average of these three models, coming to $112. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list, do click on that pinned comment below. Now, as always, we start off with a margin of safety of 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. At 15%, it is pretty much $1 shy from the current trading price, so we do see this at a 15% margin of safety based on our estimates and judgments. In terms of Wall Street, their price target pretty much not too far, in fact, from our intrinsic value based on the latest earnings report of $112. Now, they see upside of 16%, so it isn't too bad. Again, it depends on what you're looking for as an investor and what your projections are. Personally, this is one I do hold in my portfolio, but I will be waiting for it to come down into the 80s before considering adding more. But who knows, it may never get there again in the foreseeable future. Let me know your thoughts in the comments below. Are you adding based off on the earnings report? They did miss, yet the price is up. So is this a sign that maybe the share price has bottomed out? As always, if you enjoy the content, smash that like button, hit the subscribe button, and I'll see you on the next one.